All right, I think we can go ahead and kick it off and people will catch up as they come in. Hello, everyone. I'm Zach Fry with BWC, and welcome to our fourth installment of the BWC Dialogues series. This is the series to give members a chance to engage in conversation on emerging real-time events. And because of this, we very much appreciate hearing new topic ideas from you all. So please feel free to reach out to me anytime with future ideas. Um, Before we start today's CBDC conversation, one quick housekeeping reminder that the discussion today will be followed by a Q&A session, for which I ask you to use the Q&A function at the bottom of the screen, and then we will go ahead and ask you to unmute your mic and ask your question yourself. Thank you all very much for attending, and with that, I will hand it over to Greg to introduce the discussion.
Well, Jack, thank you very, very much, and good afternoon to everybody that's joining us here this afternoon or this morning, depending upon where you're tuning in. I want to take this opportunity to welcome you on behalf of the senior leadership team for the Bretton Woods Committee, and thank Zach and other members of the Secretariat for all of the work that goes on behind the scenes to generate all of this tremendous content. You mentioned this is the fourth in the series, the dialogue series, going back to April. The first of those, I had the good fortune to sit in as a panelist on that discussion, led by our president, Bill Dudley, and Bill Cohen, discussing the wake of learnings that took place when we had Silicon Valley collapse, the bank collapse. We had a follow-up when Republic also found its own demise that was led in large part by Haley Boski and, of course, Bill Rhodes and Bill Dudley. And most recently, another conversation, which I think dovetails quite nicely to what we're going to do here today for everyone, is a conversation on stable coins and whether or not there still was a need for competitiveness for the US dollar. I think our guest has a strong take on that as well. Again, my name is Greg Johnson. I'm a Bretton Woods Committee member. I'm also the founder of Rubicon Digital Assets and a professor at New York University. It's my distinct privilege to welcome Chris Giancarlo to the Bretton Woods community today. I can't think of another speaker on the subject of central bank digital currency that is more informed and has a better CV to talk about the totality of this conversation than Chris. Many of you are familiar with the fact that he was the senior regulator at the CFTC at a time when Bitcoin and digital currencies were having their moment. And as Chris will tell you, the US has actually a strong track record in regulating digital assets and digital currency, and his fingerprints are all over the regulatory framework that exists now in the United States with respect to Bitcoin. He's also a partner at Wilkie, Farr, and Gallagher. And I think notably for this conversation, I'm sure he'll speak more to this, he, along with two other co-founders, brought to life something called the Digital Dollar Project, which is looking at how the United States should be thinking about a digital currency, whether we should, and if we should, how should we consider all of the different variables that come into bear. And so without further ado, I want to introduce Chris to our audience. Chris, thank you very much for joining us. I know you have some remarks that are unique for the Bretton Woods Committee community, and so please take it away, and then we'll get into question and answer in a few moments. Thank you.
Greg, thank you so much. It really is a privilege and pleasure to be with you today. Good morning, everybody, or good afternoon, depending on your time of day. Thank you for this opportunity. I'd like to speak to you about public trust and the role of the private sector in the digital future of money. The remarks I'm going to give are unique for this audience, but they are based upon a keynote address that I gave last month at the Philly Fed 7th Annual FinTech Conference. And I'd like to begin with a quote from a friend and former regulatory counterpart, Mark Carney, former governor of the Banks of England and Canada, who I'm sure this audience knows very well. In remarks to the Bank for International Settlements in June of 2021, Carney reminded his fellow central bankers that, quote, the value of money requires not just the belief of the public at a point in time, but critically, the consent of the public at all times. When it comes to money, the consent and trust of the public must be nurtured and continually maintained. End of quote. Well, I'd like to speak to you today about obtaining such consent and trust of the public in the coming digital future of money. And I want to explain how obtaining such consent and trust will depend on not just the value of digital money, but upon the values inherent in the digital money of the 21st century, most important of which will be financial privacy and economic liberty. So let me start by observing that modern money is changing. It's expanding from fungible cash bills and electronic notations on the balance sheets of central and commercial banks to unique digital notations on new digital infrastructure operated by global decentralized collectives, national sovereign governments, and private sector entities. In short, the internet is doing to finance, banking, and money what it's already done to information gathering, retail shopping, entertainment, social networking, photography, journalism, and so much more. And what is that? Well, it's increasing efficiency and automation, lowering costs, furthering inclusion, unlocking new business models, and challenging traditional market structures. In fact, to recognize, as we do, that almost everything we know about communications and human interaction have been changed in just one lifetime by the internet, and yet somehow believe that most of what we know about banking, finance, and money itself will stay the same is naive, if it's not foolish. Banking and money and finance will be changed by the internet, and profoundly so. And amid such change, it's time to consider the essential process of nurturing that exact consent and trust of the public in the quickening digital future of money. As I said, digital currency is coming. Today, well over 100 foreign governments, representing over 95% of global GDP, are exploring various forms of central bank digital currency. That includes 19 of the G20, with China placing its digital yuan, the ECNY, in over 240 million digital wallets, the EU potentially deploying a digital euro by 2025, and the UK proposing to roll out a digital pound by the end of the decade. A Bank for International Settlements survey suggests that by 2030, there could be 15 retail CBDCs intended for everyday transactions and 9 wholesale CBDCs used for transactions between financial institutions. At the same time, global stablecoin usage continues to increase dramatically. Stablecoins settled over 11 trillion on-chain transactions in 2020, almost surpassing the payment volume of Visa and reaching 14% of the volume settled by ACH and 1% settled by Fedwire. The supply of stablecoins has grown from less than 3 billion just 5 years ago to over 125 billion today. Stablecoin adoption is inherently global, providing basic dollar-based financial services to almost anyone, anywhere with an internet connection, providing an alternative from high inflation currencies and fostering innovation upon new global open network money movement rails. So it's clear, both sovereign and non-sovereign digital currency is coming and coming swiftly. Whether or not the US adopts a central bank digital currency, many other countries are doing so. This means that American citizens and its multinational corporations will be dealing with both CBDCs and stablecoins in the year to come, whether or not there's a digital dollar. And therefore, the fashionable debate between CBDCs and stablecoins is passé. It was always a false choice, and now it's moot. The global economy of the 21st century will include a broad range of ongoing innovation in payments and money and contain both sovereign and non-sovereign digital currency. In fact, the success of one may be dependent on the success of the other. In the traditional economy, access to central bank-backed public money, the most risk-free form of money, has always been necessary to support and stabilize bank deposits and all other forms of private money. Individuals had confidence in the safety of their commercial bank deposits, in part because they know that in a crisis, they can withdraw from an ATM physical cash that's backed by a government and its central bank. It's likely that the success of non-public forms of digital money, like stablecoins, commercial bank deposits, and other private forms of payment, will similarly depend on the ready online availability of sovereign digital currency, especially as cash use decreases in some economies. And yet, too little is being done by American policymakers to shape and garner that consent and trust of the public that I talked about before in this evolution in the digital future of money. For some on the right side of the political spectrum comes highly aggressive opposition to a US CBDC that's based on little more than assumptions about key design elements, such as privacy protection, and also a disappointing lack of vision for a constitutionally compliant CBDC that could result from a similar amalgam of public and private initiatives that fostered the original internet of the 20th century. And from the left side, including some in the Biden administration, comes opposition to developing stablecoin and broader digital asset regulatory frameworks for fear it will legitimize what is already moving mainstream, and perhaps a loss of control over digital speech and its online economic expression. To my mind, much more needs to be done in Washington across the political spectrum to seek the consent and trust of the public in the inevitable future of digital money. The tenor of the dialogue needs to change. It's almost 4 years ago that I completed my service as chairman of the Commodity Futures Trading Commission. And during my time at the helm, the CFTC oversaw the launch of Bitcoin futures, the first and most successful crypto product traded in the United States that today, 5 years later, is fully legal, liquid, transparent, and well-regulated. The performance of Bitcoin futures is proof that US regulators can engage successfully with digital assets and do so in a way that garners public trust and confidence. In January 2020, after finishing my term at the Commission, I co-founded the Digital Dollar Project, a neutral, nonprofit, nonpartisan forum to consider how best to future-proof the US dollar and preserve its reserve currency status and the democratic values it represents in a coming world of decentralized and centralized digital currency networks. The Digital Dollar Project does not call for ready deployment of a US CBDC or digital dollar, but it does encourage the US to assert principled leadership in CBDC experimentation at home and digital currency standard setting abroad that is consistent with US norms, values, and the rule of law. When the Digital Dollar Project was founded 3.5 years ago, it was ahead of the curve in seeing the direction of both sovereign and non-sovereign digital currency. Now it's right in the middle of it. The champion model of CBDC that the Digital Dollar Project published in 2020 is today the most common form of CBDC being examined by agencies of the world's democracies. Some of the work of the Digital Dollar Project is devoted to real-world testing of the challenges and opportunities of sovereign digital money. This summer, the project published the results of a first-of-its-kind study on the retail use of a US digital dollar. The study revealed the potential of a digital dollar to reduce counterparty risk, decrease settlement times, expand access, and provide greater visibility and transparency to individuals sending money to loved ones worldwide. This pilot followed on the Digital Dollar Project's earlier work with the Depository Trust Clearing Corporation, exploring CBDCs for security settlement. Now, we've all heard about the many possible benefits of digital currency, including programmable, instantaneous, round-the-clock payments at much lower cost and greater access to financial services for both retail and wholesale participants. CBDC has the potential to strengthen the ability of governments to implement benefits policy, allowing direct infusions of money across economies, vastly improving the administration of payments compared to inadequate U.S. efforts during the COVID-19 pandemic, issuing paper checks to people locked up at home without access to bank accounts. Yet these are only initial achievements. Ultimately, the vision of digital currency is nothing less than the prospect of fully networked and integrated economies with digital currencies as operating systems and digital tokens as their value components. In the same way that 19th century railroad and telegraph technology weaved together North America's up to then very disconnected regional economies into one continental economy, the likes of which the world had never seen before. So does digital currency hold the promise of directly linking the world's many disparate, self-contained silos of financial activities into a series of global, digital currency-based financial system networks. Well-designed digital currencies will serve as the digital operating systems, the Microsoft OSs, for fully networked digital economies, driving far greater efficiency, automation, transparency, and access than ever before. The trajectory is toward the creation of massive scale, singular currency platforms, operated in some cases by central banks and governments. The informal currency zones, the dollar zone, the eurozone of the 20th century, will yield to highly integrated digital currency networks of the 21st. And the commercial and governmental powers that realize this vision will gain huge advantage in the digitally networked future. Yet it must be recognized that those digital currencies that prevail, both governmental and non-governmental, will be gathering points for massive amounts of data about the economic and financial activities of users, citizens, and voters. Many thoughtful people across the political spectrum are appropriately concerned about misuse of such honeypots of financial data. CFPB Director Chopra has called for accountability for commercial misuse and abuse of private financial data. And on the other side of the aisle, Florida Governor DeSantis and others are rightly concerned about government invasion of privacy with CBDCs. There is indeed recognition across the ideological gamut about the risk of direct access by government to such troves of private financial data, and alternatively, political pressure on private sector actors to conduct surveillance, report on activity, and disable financial transactions with stablecoins against disfavored groups and activities in a similar fashion to the US government's now increasingly evident censorship of speech on social media. Regardless of the form of digital currency, sovereign or non-sovereign, it's imperative that our society thoughtfully consider privacy implications and design the future of money to be consistent with key democratic laws, norms, and values. Fit-for-purpose digital currency regulatory frameworks, stablecoin networks, as well as any future CBDC, must protect citizens' privacy rights if the future of money is to enjoy the public's trust and consent. In democratic societies, lawful transactions in digital money, sovereign or non-sovereign, must be immune from commercial and political censorship, surveillance, and overweening pressure to disable otherwise legal transactions. Without it, private economic activity will be frighteningly beholden to big tech monopolies and the shifting political winds of Washington, London, Brussels, and Beijing. That's why the advent of both stablecoins and CBDC offers the opportunity to reassess contemporary financial surveillance in its entirety. It's an opening to reverse the lamentable trend of overly broad information gathering under the Bank Secrecy Act and replace it with a new architecture that can better ensure privacy, while effectively and efficiently satisfying important law enforcement and national security objectives. In fact, Individual economic privacy and censorship resistance should be affirmative design features and competitive advantage of any digital currency system related to or based upon the US dollar. Designed right, a digital dollar could run on systems that are operationally and objectively transparent, thus providing the public with independent assurance about technical function, security, and resistance to impermissible monitoring, data mining, and other exploitation. Yet such a design approach will only work if the US is willing to embrace new digital technologies and regulatory approaches for satisfying legitimate national security and law enforcement objectives. Brilliant minds coast to coast here in the United States and abroad are developing privacy enhancing, or what they call PET technologies, such as zero knowledge proofs, homomorphic encryption, and multi-party computation that enable parties to prove that an encrypted proposition is true without revealing underlying private information. Combining these PET technologies with big data analysis, pattern recognition, and other algorithmic methods will allow law enforcement to protect privacy by identifying wrongdoing when it actually takes place, rather than invading people's privacy in case it someday might. By encoding individual economic privacy into its very architecture, a future digital dollar or stablecoins based on the dollar can serve as desired instruments for both Americans and people the world over who aspire to financial autonomy and inclusion consistent with basic human rights and democratic values. So as I begin to close, I return to Mark Carney's realization that money is as much a social construct as it is a government one. Its success indeed derives from the trust and consent of the ordinary citizens who place value in it. They have as much to gain from the digital networking of the world's financial systems as do governments. But free peoples also have much to lose if they're silent in the discussion over what values will be encoded in digital money, whether sovereign or non-sovereign. The world will indeed have a range of digital currencies, whether the United States chooses to lead or follow. The question is not a choice between CBDCs and stablecoins, nor is it whether the digital future of money can be forestalled. It cannot. The real choice is between financial freedom and financial control, and the role of democratic society in driving key design choices and related regulatory frameworks. The question is whether these new forms of digital currency and the digital network economies they power will make societies more open, prosperous, and free. Will they inhibit or empower humanity in the digital future of money? And will they diminish or enhance the worth of our fellow citizens and people everywhere? The choice between freedom and servility in the digital future of money is being made right now. Democratic societies must assert their time-tested principles in a world seeking a sound foundation for a new digitally networked future. Digital currencies that effectively protect financial privacy and lawful transactions will garner the enduring confidence of free people and those around the world who aspire to live free. And the nation that fosters these digital currencies will win the economic power prize and the enduring trust and consent of their citizenry. So, my friends, let's not be afraid of this innovation. Let's not try to stifle it. Let's not put our head in the sand. Let's seize it. Let's shape it in accordance with our finest and noblest democratic values. I thank you very much, and I look forward to your questions.
Well, Chris, that was terrific. And it's interesting. This conversation comes at an important moment for a lot of different reasons. Internally at the Bretton Woods Committee, there are two incredible working groups that are taking place, really examining and providing thought leadership on the big issues of the day. One of them on the future of finance. And of course, there is a brief that is being drafted in the final stages right now on CBDC. And I'm sure some of the folks that have had a chance with the pen will be taking copious notes. I'm wondering, there was so much of your brief or your remarks that reminded me of Thomas Paine's pamphlet of common sense, which there seems to be a lack of these days. And in all seriousness, I think what you really hit home, and I think, look, the Bretton Woods Committee is easily the preeminent nonprofit dedicated to effective global financial and economic cooperation. That's a part of our credo. It's a part of our membership ethos. I can't think of another subject that we've tackled or that we've discussed that could be more disruptive to economic cooperation financially as well than this topic. And so I thought I would kick off the questions, if that's okay with you.
Yep.
And maybe go back into the Wayback Machine with Mr. Peabody, for those of you that get the reference. So go back into the Wayback Machine. You are founding the Digital Dollar Project at that particular point in time. It's now several years since. I'm wondering, have your opinions been more galvanized, the original thesis that you came into the founding of the nonprofit, or has your mind been opened up a bit more? I think about something I've heard you say on many occasions about the notion of, it's in this notion of competition between nations. It's not who finishes first, I've heard you say, it's who gets this right. But I'm wondering now, have things changed? Have you evolved your thinking in the last 3 years, given how much time you're spending on this topic now?
Yeah, thanks for that. I'll tell you what is changed in perhaps a disappointing way, and that is, I think there's some degree in critical circles of a belief that financial stability equates to preserving the status quo. And the problem with that is the status quo can never be preserved. Time marches on, technology changes everything. And I think financial stability would be better found in engaging with this innovation, engaging with this technology. And of course, the values that got us here are the ones we need to project into the future. But the status quo of systems and market participants and market structure should not be preserved for its own sake. We need to, as quite frankly, I don't mean to sound overly national boostering here, but the United States took the first wave of the internet and I think brought its values of openness, of free society, of freedom of thought, and imposed it on that innovation in a way that I think has been quite beneficial for expanding those values around the world. I think, once again, the opportunity exists for free market societies to take this innovation and encode in it those core values, those core values that all add up to how do we enhance the worth of people? How do we use this innovation for that? Rather than protect the status quo for its own sake, I think we need to be much more open. That's not to say that there are not real pockets of innovation taking place with a great deal of enthusiasm and energy. There certainly are. But I think we need to sort of watch some of that reserve guard resistance that I think is a problem. So that's one thing. I would say, however, that there's no way to stop the innovation, and it's gathering pace. What made the first wave of the internet so exciting was it was unplanned. It was sort of like a Cambrian explosion of innovation and a partnership between the private sector and the public sector that brought with it a huge amount of creativity. That's what should take place now. And I think the role for regulators, and I say this as a former regulator, is to continually to advance how do we get to the right balance point between law enforcement and proper regulatory structures and innovation at the same time. That's what we did, I think, quite successfully at the CFTC during the time I had the honor to serve there. And I think that should be a model for going forward, how regulators interact with this innovation.
Well, it's interesting you say that. I think we have, as humans and as policymakers, as business leaders, the dashboard is really crowded these days. And it's hard to have nuanced conversation when it's the most needed. And this might be a moment where it's incredibly needed. And I think what we're seeing in many of the nations in the developed world, even where there's advanced pilots that have taken place, and there's been a lot of work on this subject, it is dissolving into more of a partisan, very local, provincial conversation, rather than staying in the academic setting, in the financial setting. So to that, let me ask you a question that I know is one that would be of interest to members like Professor Dick Berner at NYU. We do have a few economists and bankers on this in this audience today, Chris. One of the legitimate concerns that I think people are taking a look at, put in the stress test category, is the notion of CBDC proliferation and disintermediating the banking industry as we know it today. Do you have some perspective you could share about how the evolution of CBDCs could lead to that unwanted and destabilizing that people are understandably concerned about?
Well, so one of the principal tasks of the Digital Dollar Project is to try to provide some degree of pilot testing of some of the many questions that exist. One of the big questions, and it's an entirely legitimate question, is whether the emergence of CBDCs and even stablecoins disintermediates banking activity. And the only way to get to the answer to that is we need to test that out. It is plausible that the presence of sovereign digital money or crypto based upon sovereign digital money in the form of stablecoins could lead to people moving money out of banking institutions faster, more efficiently in a run. But that's just an assumption or a presumption. And there's an alternative presumption people might be more inclined to leave their money in the bank if they know they can move it out at the swipe of a mobile phone rather than having to get in their car and drive down to an ATM machine to do it. We don't know the answer to that. We're going to have to examine that. Another question is whether it would affect fractional banking. Well, I'm not really sure why that would be the case, although we need to test it out. If you think about in the analog world, prudent people did not keep all their savings in $100 bills under the mattress. Some did. I had a grandparent who kept it in the floorboards because he lost a lot of money during the Depression. So some did, but most didn't. And why is that? Because that cash doesn't pay interest and the bank does. The bank is safe. Maybe it's prudent to keep some cash at home, the rest in the bank. Well, in a future where you might have digital cash that's not paying interest and a bank account that is paying interest, wouldn't the same prudence apply, and wouldn't people keep most of their money in an interest-paying bank account and only some in digital cash? Again, we need to test that out. I can't imagine that in a world where you have $10,000 and you need to you want to buy a $40,000 car and you need to borrow from the bank, fractional banking has changed much. I wouldn't imagine where banks are paying interest and digital cash is not, the same characteristics wouldn't apply. But we do need to test that out. Yeah. And that is, but the answer is not into saying it's too scary to contemplate and let's do nothing. The answer has got to be, how do we do it? And I'll give you another analogy. The e-commerce challenged retail shopping to a great extent, but it hasn't wiped it away. I think that the current degree of lawlessness that's taking place is doing more to harm retail shopping than is the internet. And so, those things can be tested. We can balance it out, but it can't be a reason to say somehow we're going to put our head in the sand and draw a line and not allow the emergence of digital currency. To think that somehow the internet is not going to do to banking and money what it's already done to everything else is just naive. Let's accept that this is coming and do the extensive degree of testing and information gathering and pilot project that we need to do to answer some of these legitimate questions.
It's so hard when you are in a place of relative strength or comfort or normalcy and stability to kind of think about such disruption. I can only imagine being in a pub in 1920s England. My daughters go to school there and live there, or sitting in the Reform Club and having a proper civilized beverage in the 1920s. And I can't imagine any of them thinking that British pound sterling would not be the dominant currency of the day, and yet it's not. And I think there are so many lessons from relatively recent history of why we should not be too arrogant to have these conversations and to look at them very, very acutely. I think that's an important piece of the puzzle. I have to
Can I just actually jump in right there with one thing? A very important participant in global remittances around the world is the Western Union Company.
Oh, yeah,
Americans know Western Union. They are responsible for tens of billions, hundreds of billions of dollars of global remittances every year, with the largest corridor being U.S. to the Philippines, where Western Union was very concerned about, and I don't want to put words in their mouth, but they were very concerned about future adoption of a digital dollar, how would it affect their business. And so they did a pilot project with us at the Digital Dollar Project. And we worked with BDO Bank of the Philippines, which is the largest bank, and Western Union, and did a pilot of how it would affect. What did they learn from it? Well, what they learned was it wouldn't actually displace them. It would actually allow them to provide a better, more efficient, and lower cost service for their clients, and yet with their distribution and their brand name still play a very important role in a digital future state. It's not the result that perhaps one sitting in an armchair in the Reform Club might have predicted. One might have predicted that a CBDC would be devastating to a remittance business like Western Union. But what the pilot proved is that a U.S. digital dollar CBDC would actually be a very affirmative and supportive of their business model. And so we've got so much testing to do if we're ever going to get this right, but we've got to be testing. One of my mentors, Dr. Richard Sander, the founder of the Climate Exchange, one of his favorite expressions is, if you want to be on time, you've got to leave early. Mm-hmm. If we want to protect the US dollar, we've got to be leading the experimentation in this way. And the only way we're going to answer some of these very legitimate questions is through pilot testing and pilot projects.
Well, speaking of which, and I know you're a big fan of the work being done in Washington, D.C. with the Atlantic Council Geoeconomic Center. They've truly, under Josh Lipsky and his team, they've taken a lead in doing a great job tracking the proliferation of CBDC testing and pilots and so forth. And I know you have a close relationship there. I'm wondering, it appears that there is an abundance this year. It's like almost hurricane season or typhoon season. We have so many names of different pilots. We're having to name each one of these. Yeah. Chris, you mentioned we have to keep testing, but are there regions that you're particularly impressed by? Are there pilots, aside from the one that you all have participated in, which I'm glad you brought up because I was going to ask about it, but are there others that you're looking at? Of course, just recently, a few days ago, we had another one with the Bank for International Settlements, which seems to have a fire lit around their innovation for obvious reasons. But are there other pilots that you would draw people's attention to that you're fond of or you're interested in, or regions of the world you're seeing things cooking?
Yeah, so there's some superb pilots taking place around the world. The BIS is leading many of them, and the work and the reports, the quality of the writing and the explanation has been superb. I would have to say I have to tip my hat to China and its ECNY, and for perhaps a unexpected reason. You said before that I'm quoted as saying the winner in this is not who gets there first. The winner of this who is the one who makes sure that their sovereign digital currency reflects their values. What I've said is that the winner is the one who develops digital currency networks that properly reflect their values. Well, the ECNY is a very effective tool of state surveillance and censorship. If that's what China set out to do in a closed society, they've achieved it very well. And the proof of that is that most of the criticism of a CBDC in democratic societies seems to be pointing to the Chinese model as the one that they wish to prevent. China has done such a good job of building a CBDC model to serve their own purposes that they've convinced the world that that's the benchmark for the rest of the world. And so tip my hat to them for not only the success of achieving their objectives, but also convincing the world that that is the benchmark.
Yeah.
But it's exactly the reason why we in free societies and democratic free peoples need to come up with the alternative. We need to build the alternative, which is what I like to call freedom coin. If the ECNY is surveillance coin, I think the free world needs to develop freedom coin, where anti-surveillance, anti-censorship is a design feature, operationally transparent, so nobody needs to trust the government to say, trust us, we're not surveilling you, but where they can see for themselves, in the same way one can see with algorithms like Bitcoin and others, that anti-censorship is built in. We need to build the same thing, and we can do that consistent with law enforcement and national security objectives with the technologies that I talked about in my remarks. But the time is now, I believe, for the West to really attach itself to its core democratic principles of free society and develop, whether it's private sector developed or whether it's government developed, and I think a combination of the both, where anti-censorship and anti-surveillance is built in, is consistent with law enforcement needs. And that's the consensus that I think doesn't yet exist in the free world, that really needs to be built. A consensus that we're not going to follow the ECNY model. We're not going to follow the surveillance coin model. We're going to follow a free society model, and we're going to do it in a way that the world, that the future, people will be attracted to that currency as much for its value, but for its values.
Well, I do think it's interesting that if you think about globally how the citizenry view the state involvement in their lives, it's very different. Of course, in Europe, there is more of an acceptance of the government being trusted in the involvement of the subject versus commercial entities, as exhibited by some of the data laws that they took the lead on, and we've followed largely. I'm interested on privacy. Let me keep going a little bit, if you don't mind, on privacy. With apologies to the American comedian Chris Rock, who recently did a special around selective outrage. The main critique of a minimally informed person on CBDC that they just hear is privacy infringement, privacy infringement. And yet, if we took that Wayback Machine to 2005, before the introduction of these supercomputers in everybody's hand, if we said to somebody, you would get A, B, C, and D, however, you're going to give up all of your contacts, we're going to geo-track you, we're going to do all of this, we're going to give up a lot of privacy. How do we think we need to have a more nuanced conversation of privacy when we've already given away in 15 years more tenets of what Americans at least think about privacy than we could have possibly imagined, whether it's just lack of awareness, I'm just scrolling and I'm going to hit yes and I don't read anything. It doesn't really matter. We've conceded, not that we should concede more of our privacy rights. I'm not suggesting that. But what I'm saying is, how do we have the conversation from a place where we've changed what we think about privacy? I'm not sure if that made any sense to you.
It makes complete sense to me, and you're right on. I mean, it's funny in this sort of surface level conversation, on the right side of the aisle, I'm just going to simplify it. It's sort of CBDC bad, stablecoins good. And on the left side of the aisle, again, this is a parody, but it's CBDC good, stablecoins bad. And yet both of them could invade our privacy to an amazing extent. In fact, you could even argue at least CBDCs would be governed by the First Amendment and would be governed by the Fourth Amendment, a right to privacy. Whereas stablecoins are not subject to that. In the same way we've learned big tech is not subject to any of those constitutional restrictions when it comes to free speech. So there's nothing to stop a government licensing authority from saying to a stablecoin operator, hey, we're not wild about people buying ammunition anymore. I know it's legal, but we're going to pull your license if your stablecoin allows people to buy ammunition. Or a right-wing government saying, we're not wild about people funding abortion, so no contributions to Planned Parenthood using stablecoins. I mean, that's not unforeseeable when we've learned what we've seen with freedom of speech on Twitter and Facebook and YouTube, et cetera. And so we've got to get beyond this wooden notion that one or the other are either good or bad for privacy. We got to move beyond that and actually say, we, the people, demand that any digital currency based upon the dollar, whether it's direct in form of CBDC or whether it's a stable coin, privacy must be at its heart. There must be operationally transparent anti-censorship, privacy protection built into the design itself, before it deserves the public's patronage. But the flip side is also true. We don't have to look at this in the negative. Let's build privacy in, because we'll make this the aspirational currency for the people around the world. In other words, let's see this as an opportunity. If we take our finest principles written into our Constitution and write it into the digital dollar of the future, people will flock to this world over, because they don't want to be surveilled by commercial entities. They don't want to be surveilled by governments, and they certainly don't want to be censored by both of them. People want economic privacy for lawful transactions. And there's no reason why we can't get that balance between law enforcement and anti-surveillance right. In the same way we do law enforcement on the highway every day. You're free to have any conversation you want in your car. You're free to transport things in your automobile. But if there's a pattern of misbehavior, in other words, if you're speeding, if you're reckless driving, police may use that as probable cause to, first of all, interdict the unlawful behavior, the speeding, and then, depending on what they notice, what gives them belief of perhaps law breaking, can get your identity. But it's identity last as opposed to identity first. Our system today has become one where you've got to put up your credentialed identity to enter in any lawful transaction in case you do something wrong. It's identity first in case you do something wrong. We need to get to an identity last and let government do pattern recognition, big data analysis to look for patterns and probable cause, consistent with fundamental notions of the balance between liberty and law enforcement that go back centuries in democratic societies.
Chris, I would like to point out for the record that we've gone about 45 minutes into a conversation, and until now we didn't bring up the word AI or the phrase AI, which may be a record in this extended Woody Allen 15 minutes of fame. Let me pull the aperture back a little bit, and then I'll go to Zach. I haven't seen in my queue if we've got audience questions, but I'll go to him in a second. One last question before we turn it back to him. Let me change gears a little bit, pull the aperture back a bit. I just spent almost a month in the Middle East, in Saudi Arabia, in the UAE, and there are many things that have been well discussed about some of the progress and incredible accomplishment that's taking place in that part of the world in many dimensions. But one thing you cannot walk away from and not notice is there is a sense that with the policymakers, within the government, within business leaders, there is a larger sense of people being born as digital natives. There is a much younger mentality around technology and an opportunity to embrace it, not build and break things, rush and break things in Web 2 speak, but there's an open-mindedness there. Are you seeing that in your global travels? Can you speak to whether or not, the age of our policymakers here in the United States has taken on a heightened sensitivity as of late, but what are you seeing globally about the impact of age on this conversation specifically?
Yeah, Greg, that's a great question, because much more than the political divide, and I parried it before, it doesn't hold true. There's plenty on the left that are very open to CBDC, plenty on the right that are very open. On the right, they're open to CBDC, plenty on the left, they're open to stablecoins. The real divide, I think, exists today generationally. I think we live at a time when our leadership is particularly pronounced and as septuagenarians, in some cases octogenarians, at a time where technology is evolving very fast. In the same way that seniors wait for their grandkids to come to help them, hook up their new computer or program it. I think that older generation are beginning to conflate systemic stability with status quo preservation. And I think they're really unprepared for a triumvirate of digital networks, AI, and quantum computing that is going to disrupt everything about that status quo that they came of age in. And they're going to rush to get their grandkids into the corridors of power to help them deal with it. I really think that we've got a mismatch between the generation that is in leadership roles and the technology, the transformative technology that is roaring down. And unfortunately, a generation that didn't grow up in a networked world is really going to struggle to understand this. And we're going to need younger leaders in these roles who are well versed in the core principles and missions of their agency. Look, none of technology changes the need for consumer protection, adequate transparency, prevention against fraud, against criminality. None of that goes away. It's almost enhanced, right? I am not an iconoclast against the institutional structure of regulation. I served as a regulator, proudly so. I believe in smart regulation, but the answer cannot be, we don't like this technology, like King Canute putting our chair at the water's edge and saying, I command the waters not to rise. The waters are going to rise, and I'm not sure King Canute and his courtiers are well prepared for this innovation. We may need a new generation of leadership that both appreciates the principles upon which these institutions are built and the missions that they have to serve, but are also not adverse to engaging with this technology openly, actively, and positively. The goal is not to be afraid of it. The goal is to embrace it. How can we actually use it to do our missions better? So in 2017, we started experimenting at the CFTC with AI to do our jobs better. We started looking at big data analysis tools. I tell a story in my book, Crypto Dad, about bumping into one of our best cattle market analysts at the CFTC. It was like 9 o'clock at night. I was leaving the agency. I was getting in my car in the parking lot, and here's this analyst. And I said to her, I said, I'm sorry you're working so late. What's keeping you here? She goes, oh, no, I'm having fun. We just got this new AI tool, and I'm analyzing the cattle market, and I'm seeing patterns I've never seen before in activity levels. This is a person who might have said, wow, I'm afraid of AI. It's going to steal my job. It's not only stealing her job, it's keeping her at the office to 9 o'clock at night because she was seeing things she couldn't see. The tool was serving as a tool, giving her greater insight into marketplaces. We need to approach innovation as regulators, as leaders, as an opportunity to be better at our job, to be more effective, to serve our constituents, to serve our people better. If we're the ones resisting this, we're doing a disservice to our citizens. We should be embracing this and using it to be better at what we're sent to Washington or Brussels or London to do.
Well, it's interesting. Thank you for introducing the notion of qubits into the world that we're with number one. And then who would have, it does make sense that the CFTC would introduce bovine AI technologies as well. So thank you for both of those. And let's go to Zach. And Zach, my apologies, I can't see if there was anybody in the queue. If not, we can keep going here.
No, not at all. So we've got one question from Antonio here that I think might be a great question to end on. So Antonio, I will let you speak and ask your question.
Well, wonderful. Thank you very much. And Chris, really riveting to hear your viewpoints. During the testing phase, there are two edges to this sword, right? And the less desirable edge really equates to people within a global citizenry losing savings and value, akin to what we've seen with some of the crypto firms that have, blown up or melted down, however you'd like to put it. To what extent do you foresee authorities from around the world needing to create policy around cooperating on enforcement? Now, technology can certainly enable this, but how likely, given your experience, is the will of national administrations to work with each other to come to some resolution, especially given, the different motives with respect to things like privacy and surveillance? Thank you. I understand it's a rather unfair question and forward-looking, but
not at all, Antonio. So I just do want to say one thing, that we certainly in this new technology, we've saw a lot of people lose money, but we also saw it in the old technology of banking just earlier this year with 3 major banks collapsing, and but for government stepping in with insurance and otherwise, they would have lost money in the old system as well. So losing money is not unique to this new digital networks of money. It's old to the old informal networks of money as well. Your point about global cooperation is absolutely spot on. This technology just wipes away borders. And therefore, it's not just an option for regulators to work together. It's going to actually be mission critical that regulators and will, in a world in which the weakest link will be where some of the worst activities will take place, the role of global standard setters like IOSCO and the FSB are going to become even more critical. And there are some structural issues in their structures as well in terms of representation and balance, but we're going to have to improve their structures. We're going to have commitments from governments to participate strongly. I served in both the Obama and Trump administrations. Both of those administrations had different approaches to their participation in those bodies. We need a much more consistent, longer term. It can't be, politically based, our commitment to participating and the rest of the world's commitment to participating, because this is a technology that just laughs at borders. And we're going to make sure that we have to make sure that the regulatory and the standard setting response is equally as comprehensive and as robust. So thank you for the very good question, important question.
Thank you.
Agreed.
Yes, thank you very much, Antonio. And we have just a couple minutes here, so I will say thank you very much to both Greg and Chris for hosting a fantastic conversation here today. And I would give you each kind of the last minute here to give a bit of a closing remark.
Chris, to you first, please.
Well, I other than say thank you, the Bretton Woods committee and the work you do and the thought leadership you bring to this. When Greg offered me this opportunity, I said, wow, just thank you so much for the opportunity to share with you, my journey into this digital network of future of money and the important role that organizations like this have, and I would say must play as this develops in the months and years to come.
Well, Chris, on behalf again of the senior leadership team, I'll continue with the thank yous here to close things down. I want to thank you, Zach, and obviously thank Emily Slater and the senior executive team for supporting these dialogue conversations. I think they're incredibly timely and important, and I know the viewership certainly got that perspective from Chris's insights. And thank you all very, very much for spending your afternoon or morning with us, and to be continued.
Absolutely. Thank you all very much.
Thanks, everyone.